Picture waking up one morning, opening your bank app, and suddenly realizing that federal authorities may have visibility into every transaction flowing through your account. Not only the large transfers, not only stock trades or international wires, but potentially every deposit, every withdrawal, every movement of money from one place to another. Now imagine you are retired, living on a fixed monthly income, carefully managing the savings you built over decades, and then you hear that a banking rule connected to the IRS could flag your account activity, temporarily freeze funds, or even initiate an audit, all because of a specific number. That number is $10,000. And beginning in 2026, that number may carry far greater significance than most people realize today. Stay with me, because the information in this video could directly impact your financial routine, your retirement savings, your Social Security deposits, and the money you spent an entire lifetime earning and protecting. This is not speculation. This is not political commentary. It is based on real regulations and ongoing enforcement policies. And understanding them before they affect you is important. Let me begin with the story of a woman named Patricia. Patricia is 71 years old. She spent most of her career as a public school teacher in Ohio and retired several years ago. Like many retirees, she has handled her own financial affairs for a long time. Each month, her Social Security payment arrives through direct deposit into her checking account. Occasionally, she transfers money from savings when larger expenses appear, perhaps a roof repair, a medical bill, or a plane ticket to visit grandchildren in another state. Patricia has always paid her taxes and has never attempted to conceal income. Yet, under current reporting structures and automated monitoring systems tied to the $10,000 threshold, someone like Patricia could theoretically appear on a list reviewed by financial regulators. Not because she committed wrongdoing, but because the pattern of moving her own money might appear unusual to automated systems that evaluate banking data without understanding personal context, life history, or individual circumstances. That situation reflects a broader reality that many older Americans may eventually face, even though most people are not aware of how the reporting structure actually works. To understand the issue clearly, it helps to step back and look at the origin of these rules and why they exist in the first place. For decades, financial institutions in the United States have been legally required to report certain kinds of transactions to federal authorities. These requirements date back to the Bank Secrecy Act passed in 1970. The purpose of that law was to help authorities detect illegal financial activity such as drug trafficking, organized crime, money laundering, and large-scale tax evasion. Under that legislation, banks must file what is known as a currency transaction report whenever a customer deposits or withdraws $10,000 or more in physical cash during a single transaction. Interestingly, that threshold has remained unchanged for more than 50 years. $10,000 in 1970 would equal roughly $80,000 today after adjusting for inflation. Yet the reporting limit never increased. As a result, over time, more ordinary transactions have fallen within the reporting boundary, even when nothing suspicious is happening. In addition to those currency reports, financial institutions can also submit something called a suspicious activity report. These reports can be filed whenever a bank believes that a pattern of transactions might suggest unlawful behavior. One pattern that frequently triggers such reports is known as structuring. Structuring occurs when someone intentionally divides a large amount of money into smaller deposits in order to avoid crossing the $10,000 reporting threshold. For instance, if a person deposits $9,500 on Monday, $9,000 on Tuesday, and $8,500 on Wednesday, the bank may identify that pattern as an attempt to avoid the reporting requirement, even though each individual deposit falls below the limit. Under federal law, deliberately structuring deposits to avoid reporting can be treated as a criminal offense. At first glance, these rules sound reasonable because they target individuals who intentionally hide illicit money. The complication arises because many ordinary people unintentionally create patterns that resemble structuring. Older Americans in particular can run into this issue for cultural and historical reasons. Many seniors grew up during periods when banks were not widely trusted or when families preferred holding cash. As a result, Some retirees still rely heavily on cash transactions or make smaller deposits more frequently simply because that is how they have always managed their finances. They are not thinking about regulatory thresholds or compliance rules. They are just continuing habits developed decades earlier. Unfortunately, those habits can sometimes trigger additional scrutiny, even when every dollar involved is legitimate. There have been documented examples reported by civil liberties organizations, including the Institute for Justice, in which small business owners or private citizens temporarily lost access to bank accounts because their deposit patterns appeared suspicious under structuring rules. In several situations, the funds involved were ultimately proven legitimate, but the process of recovering those funds required legal assistance and extended disputes with authorities. These cases are relatively uncommon compared with the massive number of financial transactions processed daily, but they demonstrate how the system can affect ordinary people. Looking ahead to 2026, discussion surrounding bank reporting and IRS oversight has intensified. Several years ago, during 2021 policy debates, one proposal suggested requiring banks to report annual account activity exceeding $600. That proposal triggered strong opposition from many groups, including retirees and small business owners, and it was later scaled back. Even though that specific proposal did not move forward, the broader trend toward more detailed financial data analysis has continued. Government agencies have received increased funding aimed at improving technological systems used to review financial information already reported by banks. Those systems can compare bank deposits with reported income on tax filings and flag discrepancies that may require clarification. In practice, the $10,000 reporting threshold remains the primary trigger for cash transaction reports. But advanced data analysis tools allow regulators to examine patterns more efficiently than in previous decades. For retirees, this can create several practical concerns. The first involves retirement income sources. Most seniors receive regular payments from Social Security, pensions, or retirement accounts. Those monthly payments usually remain below the reporting threshold. However, retirees sometimes withdraw larger sums from retirement accounts, such as IRAs or 401k plans, when they need to cover significant expenses. A required minimum distribution, depending on account size, can easily exceed $10,000. When such a withdrawal occurs, it is reported, and regulators may compare that deposit with the income information shown on the person's tax return. A second situation involves financial gifts to family members. Many retirees choose to help children or grandchildren with education costs, housing expenses, or other life events. Federal tax law allows individuals to give gifts up to a certain annual amount without triggering gift tax obligations. Currently, that annual exclusion is $18,000 per recipient. Even though these gifts are legal, large transfers of cash or multiple transactions within a short time frame may still appear unusual if documentation is unclear. Keeping clear records of such gifts can help explain the purpose of those transfers if questions ever arise. A third common scenario involves property sales or inheritances. When a retiree sells a home, relocates to a smaller residence, or moves to assisted living, the proceeds from that sale can be substantial. The resulting bank deposits may involve hundreds of thousands of dollars depending on property value. Likewise, when someone inherits money from a spouse or parent, those funds may arrive as large lump sum transfers. These transactions are legitimate and common, yet they still fall within reporting structures designed to monitor financial flows. Another area that sometimes causes confusion involves everyday financial activity that generates cash deposits. For example, a retiree might sell personal items such as a vehicle, collectibles, or jewelry. Someone who rents property could occasionally receive rent payments in cash. Others may temporarily hold money for a family member before transferring it elsewhere. Individually, these activities are not illegal, but if multiple cash transactions occur near the reporting threshold, they can attract attention from automated monitoring systems that do not have the full story behind each transaction. When a bank files a report related to a large cash transaction or a suspicious pattern, that information is transmitted to the Financial Crimes Enforcement Network, a bureau within the United States Treasury Department commonly known as FinCEN. FinCEN collects and analyzes financial data and may share relevant information with law enforcement agencies, including the IRS. After reviewing the data, authorities may determine that no further action is necessary. In other cases, they may request clarification. Possible responses range from sending a letter asking for documentation to initiating a standard tax audit, to pursuing legal action if evidence suggests deliberate financial crimes. In rare situations involving suspected structuring or illegal proceeds, authorities can temporarily seize funds under civil asset forfeiture laws while an investigation takes place. Civil asset forfeiture remains controversial because the government can hold property suspected of being connected to a crime while legal proceedings determine its status. Recovering seized assets often requires legal assistance and documentation demonstrating that the funds came from lawful sources. It is important to emphasize that the vast majority of reported transactions never lead to any investigation. Financial institutions submit millions of reports each year, and most are simply stored as data without further action. However, understanding the system allows individuals to reduce unnecessary risk. One of the most effective protective steps is maintaining clear financial records. Whenever significant financial events occur, keep documents that explain them. If you sell property, keep closing statements. If you receive an inheritance, keep estate documents and bank confirmations. If you withdraw retirement funds, keep account statements showing the distribution. Good documentation ensures that legitimate transactions can easily be explained. Consulting a qualified tax professional can also be extremely helpful. Certified public accountants and enrolled agents who specialize in retirement income can review financial situations and ensure that transactions are reported correctly on tax returns. They can also advise on required minimum distributions, gift reporting rules, and other issues specific to retirees. Another useful practice is avoiding transaction patterns that might resemble structuring. If you legitimately need to deposit a large amount of cash, it is generally safer to deposit the full amount and allow the bank to file the required report rather than dividing the deposit into multiple smaller amounts. A single, well-documented transaction usually creates fewer questions than a sequence of deposits just below the reporting limit. Understanding your rights is equally important. If the IRS ever contacts you about financial transactions, you have the right to seek representation from a tax professional or attorney. You can respond in writing, request clarification regarding the inquiry, and provide documentation supporting your explanation. Many issues can be resolved quickly once proper records are provided. Family financial assistance can also benefit from careful documentation. If relatives regularly help cover expenses by transferring money, it is wise to record those transfers and consider using checks or electronic transfers instead of cash. Clear records create a transparent paper trail that explains where funds originated and where they were sent. Another factor worth discussing involves cognitive changes that sometimes accompany aging. Managing complex finances can become more difficult over time, which is why some seniors give trusted family members authority to help with financial management. When that happens, it is important to establish proper legal authorization, such as a power of attorney, and to maintain detailed records of transactions conducted on the senior's behalf. This protects both the senior and the person assisting them. Seniors also face increased risk from financial scams. Fraudsters sometimes instruct victims to withdraw or transfer cash in amounts designed to appear inconspicuous. These scams can cause serious financial losses and may also create confusing transaction patterns that attract regulatory attention. Whenever someone asks you to move money urgently or secretly, pause and consult a trusted relative or financial advisor before acting. Public policy around financial reporting continues to evolve. Debates in Congress frequently address questions about IRS funding, bank reporting rules, and financial privacy. Advocacy groups including the Institute for Justice, the Cato Institute, and AARP have published research discussing potential reforms. Citizens who care about these issues can share their perspectives with elected representatives, because regulatory frameworks ultimately respond to public input and political debate. Looking toward the future, technology will likely play a growing role in financial oversight. Data analysis tools improve every year, making it easier for agencies to identify unusual patterns within enormous data sets. Regardless of political leadership, the general direction toward digital analysis of financial information appears likely to continue. That reality makes responsible financial management increasingly important. Maintaining records, consulting professionals, understanding reporting rules, and avoiding suspicious patterns are practical habits that protect individuals in a data-driven financial environment. After a lifetime of work, retirees deserve to manage their savings, support their families, and enjoy their retirement years with confidence. Regulations surrounding banking and tax reporting can sometimes feel intimidating, particularly when they are discussed in ways that emphasize fear rather than understanding. The goal of explaining these rules is not to alarm people, but to provide knowledge that allows them to navigate the system responsibly. The $10,000 reporting threshold remains part of the financial regulatory structure. Enforcement priorities evolve, and awareness helps individuals stay prepared. By understanding how the rules work, keeping accurate records, and seeking professional advice when necessary, retirees can continue managing their finances effectively and confidently. If you found this discussion helpful, consider sharing it with someone who might benefit from the information, perhaps a parent, relative, or friend preparing for retirement. Many people who would benefit from understanding these rules may never encounter the information otherwise. And if you have questions about related topics such as Medicare costs, Medicaid planning, or estate strategies, feel free to leave them in the comments. I review the questions carefully and often address them in future discussions. Thank you for watching. Thank you for taking financial awareness seriously, and I will see you in the next video.